Banks undergoing stress tests, news of another recession, borrowed money, investor cash, dogs and cats living together, mass hysteria. Calm. Some zen, if you will. Let's bring some reasoning to it all. Welcome back, the true money master from the Society to Advance Financial Education. Good to see Steve Beaman again. How are you, Steve?
Well, Ed, I'm fine. Fabulous that you're feeling better.
I'm feeling so much better. It was a rough couple of days, my friend, but we're right back at it here. So I am fired up to talk about stress tests and banks and money, and most of the American public has absolutely no idea what we're talking about. So,
well, you know what? We'll work together to educate them with what they need.
Go for it. Let's talk about this stress test here, because apparently the banks are still not quite getting it right. The Fed does this to make sure that the next recession won't happen. And already we got one bank that got caught billions of dollars off guard here. What does this tell us about the state of our financial institutions?
Well, the reality is most of the banks, 4 out of the 6 passed okay. Bank of America had to go back to make some adjustments. But the problem, Ed, that you have is there's a decoupling of the interest of the Fed and the banks. There's a lot of confusion on what these stress tests are supposed to do. A couple of foreign banks, Deutsche Bank being one of them, passed the stress test on their own numbers, looking at what could be a $25 billion write-down. But the Federal Reserve came in and said, no, your numbers are wrong. You look at a $50 billion write-down. So there's confusion in the banks as to what exactly the Fed is looking for, and that's causing some of this. They are well capitalized comparatively to what they were 6 years ago.
If we look at these stress tests and what they're set to do, isn't it basically, if we put this in English, set to, it's a test, if you will, to see, okay, so we're getting maybe towards another recession. Here's the things that the banks will or won't do that may stop us from sliding into it. How am I doing?
You betcha. And this isn't all that complicated. If a person looks and says a bank has mortgage loans outstanding, what percent of those mortgage loans have to go bad before the bank is really in trouble? And we're looking at numbers like 30, 35%. And so the bankers say, look, we've never had that happen. Even in the 2008 and 9, that didn't happen. So we feel pretty comfortable with our capital structure. But the Fed's debating this with them as we speak.
So the banks are using less borrowed money. They're using more investor funds. Now, that would seem to be a pretty good deal, actually, for the basic guy on the street here, because the investors are the ones who can afford losses.
They are, and the banks are much stronger than they were 5 years ago. But this gets into they're trying to reduce some of this Graham-Dodd bill. And what the banks want to do is lower the restrictions on derivatives again. They want to lower restrictions on making mortgages again. And they want to have a significant reduction in the power of the consumer credit agency that's come on to protect consumers. So the banks are playing in the sandbox once again, saying, hey, back off, we're stable, let us do what we want.
Why then are parts of Dodd-Frank still being repealed when maybe some people say the banks haven't proven that they can get past what happened in 2008? It would seem to be as if we're setting ourselves up for failure.
Well, welcome to politics. We have a brand new Congress with a whole lot of new people in there. The banks are jumping on that like sharks to a feeding. They're going in saying, hey, everything changes. We repealed Glass-Steagall. That changed. Let's look at this and change these 3 big components so we can go build our businesses. The problem is, like you say, some of us sit back and say, hey, the derivatives thing got us in trouble once. We don't mind a little regulation on those.
From what we see here from this stress test and what we know now, is the door open to another recession?
Yes, but it's not the stress test that scares me about that, Ed. It's the reality that the Federal Reserve wants to raise rates right now. You've seen the market sell off in the last week. Today, we're down a little over 1%, directly related to the effect of rising interest rates on the economy. The Consumer Michigan Index, which is the confidence index, came down in March. We've seen consumer borrowing drop off precipitously since January. I think we were at 19 billion or 17 billion in December, down to 11 billion in January. That's got the recessionary fears out there.
By the way, just to point out to everybody how they work in an entirely different stratosphere than we do, Bank of America had a small slip up in this whole stress test. They found out that they had a couple of minor errors, overstated their capital by $4 billion. Yeah, it's a small accounting, right?
Yeah, you just add a few zeros to your bank account, Ed, and we'd be there.
I'm telling you, like I said, they work in an entirely different era than we do here. It's working these dollars, and we never even know. Steve, always a pleasure. We got to keep giving people some education here and keep letting them know what's going on. The Society to Advance Financial Education, always a pleasure, Steve. Have a great weekend, my friend.
Thank you, and again, glad to have you back.
Thank you, buddy. Thank you so much. All right, coming up next, it is the proper pachyderm pronouncement. And quite frankly, if you think about it just a little bit, it is way past time this happened. We'll talk about it and more right here on MidPoint.